Welcome, welcome, welcome. Good morning, good afternoon, good evening. Thank you guys once again for joining the 9 Innings podcast hosted by yours truly, Kevin Thompson, founder and CEO of 9 Innings Capital Group. Thank you guys for joining us. As I always say, subscribe to the channel. As I always say, go and get my book, MLB to CFP, live on Apple and Amazon. If you have any questions, comments, or concerns, you can email us at 9innings@9icapgroup.com. Send us your questions, or you can go to the website at www.9inningscapitalgroup.com. Schedule an appointment. As you know, we're here to do what? Educate, empower, and engage. And we like to educate you. And that's why we have our podcast station on iTunes, SoundCloud, Pandora at 9 Innings Capital Group. We have our YouTube station at 9iCap on YouTube. And of course, we have our blogs on our website at www.9inningscapitalgroup.com. And that's what we're here to talk about today. One of our blogs we did back in October. Should you be leery of the bear market rally? And what is that bear market rally? Let's get it. Well, first, we got to discuss or define what a bear market rally actually is. So first and foremost, what is a bear market? Bear market is when you're down over 20% in one of the indexes, and we're talking today about the S&P 500. So if you're down more than 20% in a said index, ultimately it's described as a bear market. And traditionally, that is not a good thing, right? No one likes to lose 20% in their assets, especially when you have an equity-focused portfolio. So in general, people typically have some exposure to the S&P, typically have some exposure to the U.S. large cap index, and therefore they may be seeing a slight dip in their portfolio. Now, all that is taketh, sometimes it comes right back. And in general, that's called what we call a bear market rally. We will show you what that actually is. But first and foremost, back to what I was talking about, a bear market rally is basically a bear market is basically a 20% decline in an index. So in general, when you see bear markets, and I want to show you this because I think it's a good opportunity for us to do some screen share. Bear markets in general, since 1929, we've had 20 bear markets. And on average, they've lasted 20 months. As you can see here on the slide, in 1929, the duration of that bear market was 32 months. This is according to the Guide to the Market. And as you can see here, we go to the 1937 Fed tightening, premature policy tightening, and that's what we may be feeling right now. We have some Fed policy tightening in our economy that's causing a possible recession. But as you can see, the markets have subsequently declined as well. Now we go all the way down to the global pandemic recession. That was a very short bear market. As you can see, it only lasted a duration of 1 month. However, what we're looking at here is that we had 34% declines in an overall market from that perspective. So with that being said, you can see that the bear market returns are not very good. On average, about 20 months. And then as you can see here, negative 41%. Not a good feeling. However, there's a flip side to that. The bull market, what that looks like. On the other side of the fence, once we come out of these bear markets, our bull markets last almost 2 times, a little bit over 2 times longer in some respects. So when people say, oh, I got to get out of the market, oh, I need to sell everything. Well, they're selling at a low, waiting for the market to come back up. The moral of the story is staying invested. Because as you can see here, over those long-term periods, the bull markets are much longer and have a much higher rate of return, given the fact that you will come off the bottom and not only get your returns back, but traditionally go higher than the high that was put in before the bear market started. So, moral of the story: duration of the bear market, traditionally 20 months. 41% on the downside. Bull markets, 2.5 times longer. And of course, much, much higher returns. So that's one thing we need to look at in regards to why it's so important to stay invested when we're talking about bear markets. Now, get back to what we're talking about in regards to bear market rallies. Should we be leery of bear market rallies? And in general, yes, we should be leery of bear market rallies. So what you're seeing here, I believe what you're seeing here on my screen is the S&P 500 year to date. Year to date, and this year to date is going to be as of 11/30. Perfect. So year to date, S&P 500. We started the year about 47.93. We opened up, we hit highs back in January. As you can see here, when we talk about bear market rallies, this is what I'm talking about. Now, when we keep going down here, we keep going down. We haven't hit negative 20% yet. Now, when we hit negative 20%, which is here, and that's going to be on June 13th of 2022, we still fell to where we hit negative 23%. A bear market rally ensued. Bear market rallies typically go up 5 or 10%. And as you can see here, it was down 23% and it went back up to negative 17%, which is roughly about 5%. Now, markets kind of just petered up and down. And then, of course, as you can see here, we hit another 20% trough in the market on July 14th. And then, boom, we subsequently had a 10% correction in the market all the way to August 16th. So bear market rallies, what happens? You subsequently get a 5, 10, maybe 15% increase in equity prices off the lows of 20% plus. But then again, why did I say be leery of a bear market rally? Because what happens here is people are fearful. People are fearful right here when the market's down 20%. But then they say, oh, well, it looks like everything's turning around. Everything's good to go. And they want to get back into the markets here. But then guess what happens? A subsequent bear market falls or ensues. And now you not only did you sell here when the market was down 20% and bought roughly when it was going back up, but you're starting to sell again because you're thinking that, oh, the market's going to go lower. As you can see, it did go lower at 24%. As again, you're seeing this again, bear market bounce, bear market drop, bear market rally, and it goes back to a bear market. And then, of course, you see these bear market rallies again. So you'll typically see multiple bear market rallies inside of a bear market. But you will also, people also say that this is basically a bull market run. This is just a bear market inside of a longer bull market, which again, absolutely the case. Because like I showed you before, bear markets are half as long as bull markets. So it's important to understand that staying invested matters. So the question I want to ask you guys, or the question you should be asking me is going to be, hey, well, what causes these bear market rallies? Why is the market so powerful? Why is it so powerful on the upside? Well, what happens here is that you have a lot of people that are disinterested. They sell out of the markets. Let's just say it was June 8th. They said, you know what? I'm washing my hands of this. I'm selling out of the market. This market is not going anywhere. It's just going sideways, and I want no part of it. There may be other opportunities there because, as we know, interest rates started rising. So there were other opportunities elsewhere. So what happens now is that there's sellers that come in and there's short sellers that come in. So short sellers come in and they start making profits as the market goes down. So now when the market goes down, say 20 some odd percent, they say, you know what? It's time to take some gains. So they have to buy to cover. So when they buy to cover, it artificially inflates the stock market. So what you're seeing here is short covering rallies inside of the stock market when you see this brief blip up in stock prices, because now you're seeing that short sellers are buying to cover to make profits on their shorts. Same thing happens. That's what happens multiple times inside of a bull market or a bear market. is that short covering rallies ensue. In our lexicon, we call it a dead cat bounce, because what you're seeing is that short covers or short interest is basically starting to squeeze, and now you're starting to squeeze the shorts to where everybody's trying to buy the cover, collecting their profits, and moving on to maybe possibly buy into the stock market, if so. Or you'll start seeing this. Now they're basically buying the cover, and now they're going to reshort and try to sell the market again. So they're selling at higher highs and buying at lower lows, or buying at lower lows to basically make money inside of the stock market. So that's how the short covering rally works. I hope that was been a value add to you guys in regards to the understanding on bear and bull markets. So my question to you now is going to be, should you be leery of bear market rallies? And the answer is no. If you're a trader, absolutely. If you're looking to buy and sell something really quickly, be leery all day long, because you're probably going to get it wrong. But if you're a longer term investor, 20% discounts on assets is a buying opportunity. We're long-term strategists here. Our philosophy is to diversify within multiple asset classes, buy on discounts, and then basically allow our portfolio to grow over a long period of time, because that's how you make money in this game. You don't make money by buying and selling certain assets. There's some stock pickers out there that do a very good job, by all means. I have some stocks in my personal assets, but at the end of the day, if you just diversify your assets across multiple asset classes, continue to basically buy into assets as they go down, and then continually buy assets as they go up. Just have a dollar cost averaging approach, because a lot of people don't have a lump sum of cash to put into the markets. You'll be better off. And of course, the number one caveat is having a 15 to 20% savings rate. Keep it simple. All the other stuff doesn't really matter. But today we talked about bear markets, and should you be leery of bear markets? Go to my website, www.90scapitalgroup.com. Go to the October 6th Leery of Bear Markets blog. It has an explanation there, and you will be able to kind of get a little bit of insight of what we talked about today. But thank you guys for joining us. As you know, we're here to do what? Educate, empower, and engage. And today we talked about if you should be leery of bear markets and bear market rallies. And the answer should be maybe. Maybe you should be leery of it if you're a trader. But at the end of the day, most of us are long-term investors. Most of us want to just buy and hold. And most of us just want to basically make money and have inflation-adjusted returns over a long period of time. Thank you for joining the 9 Innings podcast. As I said, subscribe to the channel. Go and get my book, MLB to CFP, live on Apple and Amazon. If you have any questions, comments, or concerns, go to 9 Innings at 9iCap Group. Go to the website, www.9inningscapitalgroup.com. You can listen to us at or on Pandora, Spotify. Type in 9 Innings Capital Group, or go to the YouTube channel and go at 9iCap and get the 9 Innings podcast there as well. Thank you. Stay humble. Stay safe. We'll see you next week.